The loftiest summits beckon, and investors are making the ascent. A refreshing gust of optimism has filled the market's sails, steering equities to those rarefied atmospheric heights we last glimpsed before the pangs of the pandemic seized the financial realm. The Delphic omens that once portended an age of austerity have yielded to more auspicious auguries of plenty. A great reset is underway, where lingering risk aversions are being dethroned by unfurling risk appetites. Wall Street's parabolic S&P 500 index has vaulted to new record peaks above 4,600, joining the tech-charged Nasdaq Composite in the ether's uppermost elevations at over 13,000. Across the oceans, bellwether gauges like Japan's Nikkei 225, Germany's DAX, and France's CAC 40 have likewise eclipsed their prior pinnacles of 28,400, 15,700, and 7,400 respectively. It is as if a worldwide synchrony of markets is cresting upon the same upswelling tide. For far too long, we have sleepwalked through the bleakest of dystopian scenarios, haunted by nightmares of imminent recession. The scars of 2022's punishing 20% drawdown in U.S. stocks remain deeply etched, but the revenant of economic vigor has ultimately outmuscled such sepulchral forebodings. There will be no common recessionary grave into which our hopes are inhumed this season. The undertakers of pessimism have been routed, their dire models of eternal stagnation upturned. Central bank oracles like the Federal Reserve, so recently wielding their anti-inflation staffs with brutal austerity, have achieved their delicate calibrations. After scrambling its way to a feverish 9.1% peak in June 2022, inflation's fever has finally broken without the need for a deeper economic chill. The Fed's auctioneers of monetary tightening have stepped back from the dais, confident the immunizations of higher interest rates have taken effect. With headline inflation already slowing to the mid-6% range, hopes are rising that the Fed can declare full victory by year's end. Instead, a soft landing now seems in the offing. The economic zephyrs rustling the opening buds are carrying just the right whispers of gentle deceleration without the blight of scorching contraction. A new equilibrium has been struck between the opposing principles of inflation and growth, ending that long, heated battle of attrition between the plump-pursed money hawks and the full-lardered prosperity doves. The confluence of mild cooling with hearty employment levels has conjured an economy of unruffled poise. The punishing decade-plus of stagnant wage growth has resolved into juicy pay packets for workers at last, with average hourly earnings up 4.6% from a year ago. Yet businesses continue hiring apace, adding 311,000 new jobs on net in February alone, and in this amiable climate, corporate profits have blossomed in kaleidoscopic profusion. Companies within the hallowed S&P 500 saw their aggregate earnings surge 14% in the year's closing quarter from prior year levels. Upstart industries like artificial intelligence have particularly prospered, their revenues bursting forth like the new spring greenery under skies of abundant sunshine and fertile rain. Nvidia's flowering has been spectacular, the chip titan's net income rocketing 46% higher year-over-year to $1.4 billion. And its shares skyrocketing 78% thus far in 2024 to $312 on soaring AI demand. But even traditionally cyclical sectors have defied recessionary gravity. Despite the Federal Reserve's tight fists of higher borrowing costs, consumer spending proved tenacious. The rapacious voracity of shopper appetites left the S&P 500's consumer discretionary segment's profits ballooning 22% above year-earlier levels to $32.8 billion in aggregate. Whether scooping up electric vehicles from the likes of Tesla or indulging smart home upgrades from Best Buy, households loosened their purse strings, and communication service companies, from mobile providers like Verizon to streaming titans Netflix and Disney, posted earnings leaps of 17% to $35.1 billion on our unslakable thirst for digital connection and content. The harbingers were there for any to perceive. Late in the waning year, as autumn's rust infiltrated the foliage, many chartists still muttered of an inevitable earnings winter to grip the new year's dawning. Goldman Sachs's sages saw the S&P stalling near 4,000 by 2024's end in their pessimistic forecasts. J.P. Morgan's divinators foresaw earnings per share for S&P 500 firms cratering 9% in this unfolding annum to $218. Those blighted forecasts have shriveled on the trellis. Prognostications of bountiful profits now abound for 2024's germinal months, spanning both American and European markets. Goldman has revised its S&P 500 target higher to 4,500, predicated on earnings growth of 8% for the full year. The Swiss Beliki UBS raised its year-end goalposts from 4,325 to 4,525, banking on economic resilience. Bank of America is the boldest yet, lifting its 2024 finishing line for the S&P to 5,400, implying over 20% of further upside. From the vantages of these newly attained peaks, the landscape looks verdant with prospects. Manish Kabra of Société Générale now forecasts 40% earnings growth for the first half of 2024 among the tech titans of the Nasdaq 100. And Morgan Stanley's augurs peer across the Atlantic and prophesy that European bourses could keep rising like it's 1995, harking back to that halcyon year, which saw the Stoxx 600 surge over 20%. Some grey eminences still furrow their philosophic brows at such vacant exuberance. The grey phantasms of past manias haunt their rearview mirrors and fuel nagging doubts. The siren song of the dot-com mania ringing in their memory's ear gives them prudent pause. They recall how that delirium of the late 1990s culminated in the grisly tech wreck of 2000, erasing $5 trillion of investor wealth in its cataclysmic denouement. Today's effusions of optimism strike them as harbingers of another bubble destined for an equally abrupt end. But the consensus holds that today's spring renaissance feels less a hothouse mirage than the earnest of warranted optimism. As Liz and Saunders of Charles Schwab asserts, you're not getting the broad overvaluation of companies that don't make money the way you did in the tech bubble. The seeds being planted have taken firm root in the soil of actual earnings and cash flows. Kane Gwynn of Research Affiliates reinforces this view, contrasting today's fertile landscape to the arid absurdities of that prior age. Back then, profits for many companies were pipe dreams, not reality. Today's surging tech darlings like Nvidia may boast nosebleed valuations, but they actually have earnings to underpin those valuations. The chipmaker may trade at a heady 70 times profits, but those $1.4 billion in quarterly earnings are very real nonetheless. Still, we must be wary of manias overtaking us, as certain bellwethers flicker with speculative excess. The vagabond Bitcoin has resumed its feverish wanderings toward new apogees of froth, cresting above $35,000 for the first time since the depths of the crypto winter, and gold siren luster has rekindled its ancestral spell upon the reptilian sectors of the soul, the yellow metal punching past $2,100 an ounce. Even within the equity markets themselves, signs of intensifying speculative fervor abound. As Savita Subramanian of Bank of America notes dryly, it's been more euphoria around themes rather than the broader market. The AI motif has taken on aspects of modern mania, with the bank's thematic AI basket more than doubling in 2024 already. EV plays, clean energy, cybersecurity, stretch valuations indicate overheated enthusiasm gravitating around such buzzword concepts. Yet on the whole, this rally seems borne aloft by fundamentals more than mere zephyrs of glamour or fancy. Corporate balance sheets remain fortified in their war chests of cash, with net debt ratios lower than pre-pandemic levels across the S&P 500. Economic engines still rev with vigor, expanding at an above-trend 2.7% annualized rate over the past 2 quarters. Evan Brown of UBS Asset Management observes, it's like a reset of the risk cycle. Everyone's been anticipating a recession for a long time and it hasn't materialized. He describes the growing enthusiasm for stocks as a release of pent-up risk appetite. After years hunkering defensively in the bunkers anticipating air raids of negativity that never arrived, investors are finally blinking themselves awake and embracing sunnier potentialities. There is wisdom in not resisting overmuch the prevailing winds when they hearken fair. Nevertheless, we would do well to unfurl our sails and journey where the oars summon, with of course a firm grasp upon the tiller. For this voyage, the airs presaging plenty appear to have the upper hand. As Kane Gwynn concludes, the market doesn't seem to have yet priced in all the good news. The skeptics may carp, but few want to be left behind as fresh horizons of prosperity come into view. As visions of expansive new vistas unfurl before market participants, the siren's call to ever more exotic investing shores grows louder. The venture capitalists and private equity barons sense rising tides of liquidity floating all birds in their paths. Having profited spectacularly from transitioning dull manufacturing enterprises into metric-devouring software behemoths, they now train their sights on the next transformation. Generative AI represents the new El Dorado, teeming with unplundered opportunities to arbitrage outmoded business models into scalable tech disruption. Anthropic and its illuminated ilk beckon as the seeds of a new firmament. Their lantern-coated emissions of text, image, video and code hold the catalytic spark to ignite a Genesis-like upheaval of commercial spheres as disparate as healthcare, education, scientific research and creative arts. The VCs have already staked their claims, pouring untold billions into the fertile soil of this primordial universe. Established titans like Sequoia and Founders Fund endeavor to reenact their seminal bets on search and social media in this parallel dimension of Promethean potential. Upstart funds like Lightspeed's AI Botsmiths and Bowie Capital multiply like Rutiel offshoots, all competing to invest in the foundational models and applications slated to rewrite the operating codes of industries. The enthusiasm has rapidly achieved escape velocity, with OpenAI's valuation soaring into the stratosphere at $30 billion even before its conversational model has achieved commercial liftoff. Iconoclasts like Elon Musk warn of existential overhang, while optimists like Bowie Capital's Ella Bowie see the AI flywheel as opportunity of the century to revolutionize productivity on earthly and cosmic scales alike. The gold rush mentality feeds upon itself, as each anointed unicorn reinforces the perceived inevitability of AI's impending coronation. Yet governance nightmares loom as these infinitely scalable, autonomously iterating AI models progressively outstrip their creators' understanding and control. Emergent behavior, entropic error compounding, and value alignment dissonance threaten to send these sui generis intellects transcending along dissociative pathways unguided by human values. Do the economic incentives ultimately skew towards a maritime mirroring of virulent biology or a Byzantium of coherent cooperation? Regulatory rifts have opened, with national blocs staking their dominion. America unleashes its generative marvels with nary a whisper of encumbrance, while the European Union enshrines its AI Act to promulgate strictured provisionality around these synaptic sibyls. Beijing embraces its mercantile preeminence in the hardware underpinnings, while seeding its own parallel AI ecosystem groomed for obedience to centralized control philosophies. On the Main Street investment avenues, sentiment ebbs and flows with the shifting news tides presaging either AI's inexorable ascendancy or its imminent peril and disruptive collapse. Reddit and the proverbial online message boards form the vector arena where passionate investment takes shape. Aggressively scented bots spar with shills and doomsayers in an endless barrage of dueling forecasts and book-talking. Every earnings transcript triggers obsessive scrutiny for the secret semaphores broadcasting which constituents will thrive or languish in the coming AI troposphere. The market maven's quest has grown richer with narrative enticements. Beyond the narrow frame of short-term earnings revisions, an AI mega-narrative of disruptive consumption and economic rebirth elevates the field's urgency. To extrapolate a multiplicity of alternating futures branches the mind's labyrinthine pathways a humbling journey through realms of radical uncertainty. The monomaniacal grazer narrow-lensing data risks obliviousness to the burgeoning chrysalis within which its object warps and transforms. The fortunate navigate with open peripheral framing and elastic, upshifting intuitions, maintaining and embracing transcendence as the old skein phrase before the new beginning its gestation. For in this generative catalysis, the frontiers of investment themselves undergo profound metamorphosis. The primordial mists slowly resolve into novel edifices of value, merit and meaning amidst a progressively elucidated cosmos. Those souls enkindled with optimizing Promethean fire will inherit the resplendent new continents rising from the ancient ocean's turbulent churn.